Welcome back to another episode of Trades Talk. Maggie Wymore here. In today's episode, we have Stephen Benavides from Superscapes out of the Dallas area. Stephen has a unique background in taking Superscapes and getting them tied into private equity investment. He talks all about their road to get there and what they're doing now and pivoting towards the future with that investment. Justin, what are your takeaways?
So today's episode, we're going to talk a lot about private equity investments, looking at your business as an investment, and really when you decide, if you decide to partner with an investment banker or private equity or platform company, what you want to look for in that partner, and not just taking the first person that pops into your inbox. So Stephen really takes us through that whole process that he went through while partnering with Superscapes and Crux to create the platform company that is Superscapes today, who are doing north of 50 million this year and are on an absolute tear in the Dallas market.
Yeah, I think one of the things that I took away from this episode was some of the numbers that he threw out, and I'm not going to give any spoilers, but he threw out some very specific numbers to look for in your business to make specific pivots, whether it be to bring in a consultant, to join a peer group, to look for that private equity investment. Those specific benchmarks are something that I find very valuable and that our listeners will relate to very well.
Yeah, we cover the whole benchmarking around EBITDA and what you can expect in terms of as you scale EBITDA, what type of investors, private equity you're going to attract. And really, we talk a lot about how to get there, actually. We get into the nuts and bolts of converting construction jobs into maintenance and how Superscapes went all construction from 2016 to 2019 and then have now pivoted back into maintenance and are closing in on that golden 50-50 mix. And Stephen kind of talks about how they did that.
Yeah. Well, should we dive in? Not keep them waiting any longer?
All right, guys, let's go. All right, guys, we got Stephen here on the podcast today. Stephen, you want to give us a little background on how you got here today, your background in landscaping and everything you're about?
No, Justin, I appreciate the invite. I'm excited to talk with you and to Maggie, kind of about where I've come from and what we're doing right now with Superscapes and Crux. So it's kind of a 15-year journey that led us here. I have been super good friends. He's been a business partner, one of my closest friends in life with Sean Clayton, the CEO of Superscapes. Our children grew up together. We've just had a lot of great experiences these last 15, 18 years. And about 12 years ago, Superscapes, which is was a small landscape company in the North Dallas area, started making the transition to kind of larger commercial projects, doing some construction installations that required a little bit more formal financial planning, a little bit more rigid reporting. Some bonding requirements were starting to become more of an issue with Superscapes, and Sean, God bless him, just that wasn't his background. He's a landscaper through and through, and can sell anybody in any room he walks into. But he came to me knowing that I had more of a financial background and had sold a few businesses of my own in the past, and asked for help, and I said absolutely. And that was kind of my foyer into the landscape world, seeing kind of what he was doing, helping him kind of take that next leap up into a larger project, larger presence in the commercial landscape industry. And since then, I kind of served as his kind of de facto CFO, on a part-time basis. We worked really well together, growing Superscapes up until mid kind of 2019. And at that point in time, Sean approached me and said, you know what, I think it's time to take some chips down off the table and see what the company is worth. Of course, he's gotten approached multiple times by various potential partners, both just pure financial partners, some more strategic companies that were in either the same industry or complementary industries in the North Dallas area. So I said, okay, well, let's do it. And Superscapes was at a size at the time that really going and finding an investment banking group made sense to leverage their network of potential buyers, leverage their manpower to developing the information memorandum and really doing a full auction process, which not all companies warrant that level of effort when they're going through a sale. We started that process in the summer of 2019. I remember vividly the conversation. We were kind of on the back porch of our golf club. I'd just finished playing golf and decided it's time to sell.
If you don't mind sharing, what size approximately was Superscapes at that time, and what size do you really need to be to warrant that type of attention?
Great question, Justin. At the time, Superscapes was doing, well, I'll fast forward 6 months because I know those numbers intimately because that's kind of what we closed at. So at the end of 2019, Superscapes was 36 million top line revenue, doing roughly 18% bottom line margin. So those were the heydays of the landscape industry.
That's strong. Yeah.
Really strong.
My eyes got very big at that.
Yeah. So, and there was some definite strategy in thinking, okay, is now the time to sell? We had 2 good, strong years in 18 and 19 that led us to think, okay, now would be a good valuation window to evaluate the company. So we started down that process that summer, and, hundreds of phone calls with potential buyers, mostly pure financial buyers. These are other private equity groups from all over the country. Normally, we start out with doing just intro calls after your SIM, your confidential information memorandum is kind of distributed out amongst the network of your bankers. And I think we maybe did 60 or 70 of those intro calls after they looked at the SIM. And just to kind of get a feel, I would almost equate it to like those speed dating things you see, go on where you're just trying to get a feel for, would this be somebody I'd want to work with? You're really not talking, dollars at that point or structure. You're just trying to get a gauge of the sincerity of their interest. And then, investment bankers will typically then try to wean those things down and start asking the dirty questions of, where's the money coming from? What kind of valuations are you guys seeing in the industry? And we narrowed it down to probably, I want to say 6 that we did in-person meetings with. Some guys, were flying in from New York, other parts of the country. And then we met with some local companies here, Crux Capital being one of them.
And Stephen, sorry to interrupt, but I do want to kind of ask you on this process of going from 80, 90 phone calls and weaning that down to single digits. What were some of the things you, as working as that CFO, almost advisor to Sean in this moment, what were you personally looking for in these speed dating rounds when you're talking to these investment bankers, private equity individuals?
Great question. I was really more looking for, had they done similar sized deals recently, either in this industry or similar sized companies that were in just general construction space? What kind of value were these companies going to bring to the table outside of just cash? Okay, so I would advise anybody doing this or looking at doing a potential transaction with their business, it isn't just about getting the highest dollar amount.
100%.
I'll say that is more important depending upon where the owner is in their career in terms of, are they looking at a full exit? Okay, I'm done. I don't want to transition this to a second generation or third generation. Then, of course, top line valuation is probably more important. Versus you take a CEO like Sean, who very young, relatively speaking, he was, let's see, that was 4 years ago. He's 40, so 45. So still, a lot of life left in the tires, did not want to fully walk away. So then you're looking for different characteristics and qualities in the people you're going to partner with.
Yeah.
And so I was more looking at that. And then talking about just overall structure of the deals. Some groups will be a lot more aggressive in terms of how they structure it with debt versus equity. They will be a lot more aggressive or less aggressive in closing schedules and how fast they want to get a deal done. And I'm quoting my partner, Wayne, here. I mean, time kills all deals. So you don't want companies that are going to say, yeah, we're going to do this, but it's going to take us 9 months. That's kind of a no-no kind of thing. You really want to proceed vigorously once you get a deal kind of inked in terms of an LOI executed. So
with that, you were talking about financially set up correctly, debt versus equity. I'm gonna actually kind of go backwards a little bit and ask you mentioned that 18% margin, and that's sticking in my brain. That's a unicorn in the industry. So
yeah, I wish we were still there today right now, but COVID and a lot of changes in our space have made that tough.
Yeah, the Dallas market is exploding though, I will say. So that is a little unique from where you're at and geographical setting. But going back to how did you guys, besides just, you said a little bit of luck and the economy doing good, what other strategic moves did you make to get to that 18% margin? And then to follow that up, what financial characteristics were you looking for in a private equity firm based on, debt and all these different things that you're just discussing, because to like maintain that 18% margin where you're at?
It's a little bit ironic that a few years before we did the deal with Superscapes, they made the decision to kind of exit the maintenance side of the landscape space and focus solely on the construction. Labor was a big constraining factor for us. It was very, very tough to find good labor in the Dallas market.
Was that H2B affected?
We do utilize the H2B program. It goes year to year, depending upon what percentage of our labor force we're going to supplement with the H2B program. And I can talk a lot about that, as we progress.
Well, I'm just thinking the timeline fit to kind of when they got rid of the returning workers exemption. So I was just trying to see if that correlated to it at all.
It's always an X factor with us as far as, what round are you going to get? How many guys are you going to get? And to base a business model on that is
risky.
It's tough. It's risky. Yeah. So love the program. The guys that we do wind up getting are all great workers and just want to earn a great wage and support their families. So I'm a huge advocate of the program if we can just work out a few kinks. So contrary to now what the industry is seeing, where maintenance and recurring revenue is such a huge part of your enterprise value, back in 2015 and 16, Sean and Superscapes made a conscious effort to exit the maintenance business and focus solely on the construction. We were kind of seeing that post-Great Recession boom, particularly in the Dallas-Fort Worth market. We got a lot of public work with the school districts in North Dallas that generated a lot of very, very high margin work. Ironically, typically public work would be lower margin, but we were able to capitalize on some great relationships. And, it was just so much so fast that it was almost like if you could perform the work, you got the contract. And we had a ton of general contractors that afforded us, good opportunities to kind of get that last look on where we kind of needed to be, because we'd proven ourselves as great operators and great deliverers of quality product and services. So that's really what Sean, our CEO, is just so good at in terms of solidifying relationships with great partner companies, general contractors that drive so much of our construction work. So leading up to 2020, we were very, very heavy in construction. It was very high margin construction work, but a ton of construction. I would think we were maybe like 75% of our revenue was coming from new construction versus 25 was doing just commercial maintenance. So a little higher margins, but a lot less predictable.
But you guys were still able to get a deal done even without that 50-60% of maintenance in the book of business.
We were just a tremendous amount of trust and confidence that we were transitioning kind of in late 2019, and we were seeing these metrics of so much of our maintenance contracts was coming from our completed construction work.
Right.
So if we start tracking as kind of one of our KPIs or key results that we measure is what is that conversion rate of construction work over to maintenance above and beyond just normal warranty periods, but then also what is a typical annual maintenance contract as a percentage of dollars spent on construction. So if you're spending $100,000 on a construction project, that equates to a $12,000 a year maintenance contract. And start looking at those kind of metrics, and we saw, golly, there's this huge potential backlog that we need to focus on and really stress that we capture to generate this recurring revenue. And over the last couple, 3 years, we're now at that. I mean, our construction, kind of like you, Justin, our construction has really picked up over the last 3 months. So our ratios have kind of got a little bit wonky just in Q3, but we're at that probably 55-45 ratio of construction to maintenance. And when I say maintenance, I'm including base contracts, but also enhancement work and subsequent irrigation repair services and whatnot on those base contracts. So we're super close to that golden 50-50 split, which is always been a target of ours, because the EVs go up significantly when you get past that.
So where you guys were at 36 million 2019, In that transition to getting closer to that 50-50 split, where are you guys at now as far as growth? Have you grown the top line revenue, or is
Oh
something
yeah,
that's going to hit as
I
well?
think this year we'll hit maybe 51 top line.
Nice. Congratulations. Over the 50 mark.
Yeah, 50. I mean, I think our target budget was like 47.
Yeah.
And we've exceeded our top line budget, this year. Again, a lot of it just in this last Q3. We've really blown through some numbers and gotten a lot of work completed. So we've always had this really, really big backlog, particularly through COVID. But now in the year subsequent, we're just still playing catch up. We've got a lot of jobs that have been on the books for a while. And as anybody knows, landscape, that's the last thing you do on a construction project.
Yeah.
And so it just seemed to get pushed and pushed and pushed, getting job sites ready and trying to square peg a round hole into job sites that really weren't ready. And that wound up eating into margin. And we don't do that anymore. And so a lot of this backlog, like we're going into next year already fully booked up construction wise at north of $50 million worth of construction alone.
I think your attention to converting those construction jobs into maintenance customers is something that many of us who focus on construction miss. And I think the reason is because we split our teams up. One team's focused on maintenance, the other team's focused on construction. Whether it's operation or sales, they tend to be separated. How have you guys been able to bridge the gap between the construction operation and sales team to the maintenance and operation and sales team? Are you guys doing some type of an onboarding, getting the customer in front of the maintenance salesperson? How do you convert those construction jobs into recurring maintenance contracts down the road?
The biggest thing is, we typically will not do a construction project or we won't warranty anything until we have the maintenance for a year. So that's just built into every one of our bids now. There is a 1-year warranty period that only applicable if we are maintaining the property. So when you're talking about these larger construction projects, that's a risk that most GCs and owners aren't going to want to risk losing. Particularly the last couple of years, we're here in Dallas, we've had some really hard freezes 1 week or so each winter and have lost a lot of materials. So that's been very valuable to the owners. So we have that kind of that 1-year window and as long as you deliver, and put your money where your mouth is, they're not going to want to switch. Now we are not the low cost provider of construction or maintenance in our market, so we definitely have to deliver very, very high end services to our customers. A lot of it really is just putting in some tracking and some metrics, what gets measured gets managed, and knowing what are those conversion rates and just bringing it to the forefront as much as you can with your team members and said, look, if we're only converting 70% of our construction work into maintenance, we're losing work. We're losing enterprise value by not doing that. They're basically yours to lose. If you put in the system, if you put that pipe in the ground, you've planted that tree, it's yours to lose.
I love it. I love that mindset. And that it sounds like your conversation about maintenance starts when you bid the job at the very beginning. You're talking about maintenance at that point. Is that right?
Absolutely. We're looking at our construction projects now, not just through the lens of gross profitability on that work, but what is that potential maintenance contract? And sometimes do we even get more aggressive on the construction bid, knowing that there's a huge, huge maintenance contract or maintenance relationship even down the road, so not so much as a loss leader, so to speak, but we can get way more aggressive when we know there's a substantial maintenance contract.
You got down to 6, you ultimately partnered with the 1. Is this maintenance push and kind of essentially like buying some of the construction business to make sure that you lock in a maintenance contract moving on in the future? Was that something that Crux gave to you as an idea, pushed you in that direction? Or is that something you guys all decided on as a leadership team? What happened?
Very, very early on, when even before we closed and we're having a lot of conversations and working intimately with Wayne and the team at Crux, maintenance became a huge, there was a huge spotlight put on it. That's where the perspective of not so much bottom line cash flow or earnings today, but building enterprise value over a longer period. That's the lens that a good private equity firm will look at. So yes, as we were going through the process, it was like, guys, we got to focus on maintenance. That's what's going to turn an X $1 million company into a 3X $1 million company in terms of valuation. Maybe not revenue, maybe not bottom line cash that month or that year, but valuations are you'll get 3, potentially 4 more turns of your earnings if you are a super heavy maintenance business.
100%. Yeah. We even see that in the tech world, the world that I work in on a daily basis. ARR is the big thing that they measure on. And
our monthly reports, it's all ours is MRR, but it's that's a key number that we look at all the time. Amazon's worth what it's worth because of that prime, $100 a year deal. Not because they're making a lot of money on paper clips.
Or making a lot of money on me ordering things daily. So yeah.
Exactly.
Yeah. So I've heard you mention EV or enterprise value a few times now. It seems like that is at the core root of so much of your conversations from a leadership and executive standpoint at Superscapes. How is partnering with the private equity team, Crux, given Superscapes a new perspective on enterprise value and building a company that's more than just a landscape cash cow, but actually something that's worth value from a enterprise value, as you put it?
Well, Justin, that the lens that Crux, or I think any good private equity group or independent sponsor investment group will look at, they're not necessarily looking at, how much cash, distributable cash is coming out of the investment. That's not really a goal. They're looking to place money into businesses, not necessarily take money out of businesses. So looking for the best use to deploy capital is kind of, what I always look at, not just from my involvement with Crux, but also just personally, everything. It's like, where is the best use of this dollar? And as long as the landscape business and Superscapes is generating those values and those returns, on the capital that's invested, and that's either through equity that's being raised or leveraging a good banking relationship with debt, there's any number of ways to view what your return on capital is. And so putting enterprise value kind of at the forefront of all of our analysis. It isn't so much, did we make money this month? It's, are we hitting our plan? Are we looking like we know what we're doing? Whether or not that, whatever the details of what that is, may not, as a sole owner where you're operating this business, this is how I'm feeding my family. This is how I'm paying my bills. This is how I'm, paying the mortgage company, versus I'm trying to increase the valuation to my investors, and Sean, and the team at Superscapes are some of our biggest investors, so there's definitely, we are arm in arm with the team, and everybody's goals are aligned as far as what the payday is going to be for this investment, a year, 2, 5, 10, whatever the right time is down the road. Right. And I think that's something that a lot of business owners, and I've been guilty of it too in my career, not just with what I'm doing right now with Superscapes, but with other businesses, is a lot of times CEOs will not understand that they really have two hats that they need to wear. There's the hat of being the operator, the CEO, the leader, running the business, running it efficiently, running it profitably. But then I'm also the owner. Okay. And as an owner, I'm looking at, is this the best use of my capital? Whether it be time, cash, expertise, whatever. And when you look at, you've got to look at it from both perspectives and know, am I doing right by myself as the CEO in paying myself a good wage, managing my time effectively, work-life balance, all those things. But then am I doing a good job for my investor, which in many cases is the same person, that most business owners, particularly in the landscape space, this is by and large, their biggest portion of their net worth on their balance sheet is their ownership in their company. That's with almost all business owners. Different than people who don't own their own businesses, they'll say it's their house or some other investment, but this is your nest egg. And a lot of times it's tough to put a value to it because it's not a liquid type thing. It's not a stock that you're looking at when you log into Schwab or whatever like that, or see on the news, but it's real. And that's, you gotta look at that investment separately than you as the owner. And I think a lot of times that line gets very blurred.
Absolutely. Yeah. I can relate to that. Yeah, being a CEO/owner, it's something that we try to keep our employee hats on as employees and then put our board member investor hats on as owners. And we're a family business. But when it comes to making decisions, investing in technology, investing in equipment, investing in people, it's really hard to spend money to build your company up in that investment framework when you're so focused on the bottom line profitability every single month. It's got to hit this. It's got to do this.
Right.
I think it holds a lot of people back from making decisions that would ultimately make their business much more successful and much more valuable in the long run.
Yeah. Just put a good plan in place. If the goal for you as an owner of this business is free cash flow, that's great. Just know it going in. If the goal is enterprise value to build an asset to transition to the second generation, that's great. Plan for it accordingly. And your goal is not to suck out. I mean, I look at so many businesses where I just think to myself, how in the world are you sleeping at night running this business so undercapitalized? You're sucking every dollar out. Yeah, you may be earning, and I'm using my air quotes there, earning a great living, but it should be done so much different with proper structure and good planning. So,
well, and with that, I mean, at different points of an owner's career, you could be focused on different things.
absolutely.
And yeah, and I think what we're starting to see is this shift in like a generational shift in the industry. Part of the reason Justin and I want to start this podcast is because we truly feel like we're the next generation of this landscape industry. And what we're finding more and more is that owners in their 60s and 70s, they're not knowing, they haven't set themselves up for that transition, whatever it is. And then they're kind of stuck working still in the business and don't know what steps to take to exit. So ultimately they just either sell for way under what they should, or they dissolve, or they pass it on to someone probably shouldn't be running a business. So do you have any specific advice for those owners out there looking to make that generational shift?
Well, if the goal is to pass on, to the next generation, landscape as an industry is one of those, there's low barriers to entry. It's typically not viewed as a complicated business, even though in many ways that it is.
I'm going to argue with you on that. It's pretty complicated.
I know, I agree. I think it is too, but it's kind of viewed in so many ways by a lot of people as a simple business, and it can be at certain scale and sizes, sure.
If you keep snow out of it too.
Yeah, Christmas lights or stuff like that, or immigration law, definitely. But I'll just go back to just have a good plan in place and view this truly as an asset that you own, not just that you work in. And by doing that, you'll set up that next generation, I think to have a higher likelihood of success. I've seen a few businesses that kind of crumble because the second generation, I mean, they don't have a passion for it. And in many ways, and I've learned this from just being a part of the peer group with ACES and McFarland Stanford. The owners in our space are by and large very, very passionate about what they do. They really enjoy it. They like the rewards of what they construct. They like the rewards of what they maintain. They like the fact that they're able to provide good paying jobs for a lot of people. I take great pride in the fact that I'm able to provide good wages and good standards of living for a lot of people in the Hispanic labor force. That's a benefit. And so when you do that, make sure that the person that you're wanting to transition this to kind of shares those same values and those same goals. Because if you're just passing it on because, hey, dad over here, he made $1 million a year for 20 years, great job, did well, blah, blah, blah. But the son, man, he didn't get it. He doesn't want to be in this business, just be careful about that. Because you could very easily, transition the company to somebody else and who does have that passion and do something that the second or third generation does care about together. So just don't force it. It's super obvious to tell. I mean, Justin, I think you'll shake your head. There are some folks in our peer group alone that were thinking, you know what, the second generation just ain't going to get it done.
Nope.
Compared to the founders. And there's nothing wrong with that. Just acknowledge it and be very truthful to yourself and know what you're doing in that transition. And when's a good time? Don't wait too late to where you basically aged out of wanting to materially participate in the business and you kind of leave the second generation stranded. But, I've seen a lot of companies where that second generation is already in their 30s or 40s and kind of always being viewed as, the owner's son or the owner's daughter. And that doesn't bode well for establishing credibility and authority in a new company.
Yeah, I'd say don't be too proud to transition out. Don't be, too protective and proud. I mean, but even you, Justin, I mean, your father is still involved and he's still on the board. You still bounce ideas off of him regularly. So you can still have a presence and a say, but don't be too proud to transition.
And I wasn't
it on.
talking about you, Jessica, when I was saying
I know.
No, he was like 25 when he took over. So
well, I don't know, Candy. I
don't know. Well, yeah, just on this whole generational transition thing, I think I just got to, my parents both, they let go of the reins and gave them over to me and my brother and my sister and my cousin, with me kind of at the helm of the ship. But one thing my dad has always done a really good job at is he stays involved, but he's very humble and supportive. So he doesn't try to take credit for anything. He doesn't try to make himself look like the center of the show. And he's there, but he's not trying to steal that presence of leadership. However, when we go to sit down with a bank, or we go to sit down with an investment team, or we go to sit down with top clients, he's there with us as a representation of the board and a representation of the first generation founder. So he's been able to kind of fill these two roles where he provides stability and foundation in a growing company, but while also passing on the torch and passing on the spotlight to myself and my siblings in a way that has really benefited our company. And Stephen, to your point, I think he's done a good job at looking at the company from an investment standpoint, not looking at it as a job standpoint, right, and really definitively differentiating between those two roles, which there's a huge opportunity for those listening, founders or second gen or third gen, to find that place. And EOS calls it rocket fuel. I think there's an opportunity there.
Yeah. And
we had to, very, very early on, as far as establishing continuity plans and, with Superscapes, as far as, from, I hate using everybody's term, somebody gets hit by a bus. I use the term somebody wins the lottery, instead. If your CEO wins the lottery and they're like, okay, guys, I'm done with this, have at it. You got to have plans in place for how does this continue without that person. It isn't always just I'm aging out, or there's any number of circumstances that you've got to plan for. And I think, Justin, like you said, with your dad, staying in as a presence within the company, but not directly, overseeing or commanding that authority. I think that's really, really important. Every ship needs a captain, and it's got to be very, very clear who that person is. I'm involved in some other companies that we're struggling with that right now. They always seem to revolve around, kind of family-owned businesses, big, wide families, where a lot of brothers and sisters and stuff like that. And it gets tough, and that can spawn, dissent amongst the team members easily. So I think, Justin, you've done a great job, from what we saw out there at your company on our site visit and just our conversations, it's not easy. I mean, you throw family into the mix of any company and it's a little more difficult.
It makes Thanksgiving dinner a little bit more interesting.
Yeah, sure.
One recurring theme I keep hearing from you, Stephen, is about the peer groups. And I know that's how Justin, is through the peer groups. Can you speak to maybe some of our young owners out there listening, or people looking just to get involved in peer groups? Is it worth the investment? What point should you get involved? Should you transition to different peer groups at different times? Give me your thoughts on the whole peer group idea as a whole.
Sure, right. I will say, well, there were a few questions there. Let me preface this with, this is my first peer group to have been involved with in my career. It is 1,000% worth the investment. And I'm kind of in a somewhat unique position with our peer group, in that I kind of represent the investor owner of the member company, Superscapes, not the founder, CEO, operator. So, I kind of bring a different perspective, and get to absorb, some different perspectives from the other members. I'll say I would not think there's any minimum company size that would warrant joining a group like what we have with ACES or any comparable peer group. I think probably the earlier the better, to be perfectly honest, because it's just such a good sounding board for ideas, validation for what you're trying to do, what you're failing at, what you're succeeding at. I love the fact in our peer group that, we all, share intimate details about our business and what's working and what's not. egos are checked at the door. We're not always putting our best foot forward like you see on social media. We're talking about real problems. We're talking about ideas and challenges that other companies have faced that we're all going through at some level of degree, that either we've been through it or we're going through it now, or we know that once we get to this level, we will go through it. And so I think they're great. I love, the on-site meetings that we have with our team members. I mean, Justin and I just got back from a wonderful, 2-week trip in Italy, that we all just decided, let's have our meeting over there. And
yeah,
I
never thought landscaping would take me to Italy.
Yeah, nor I. And it was a great trip, and just good to know that you're not alone with the challenges you're going through. With everybody's got to make payroll, everybody's got to deal with the bank, everybody's got to deal with taxes and accounting and technology and labor, and it's the same across all these companies. So whether you subscribe to the misery loves company or success breeds success, it's just good to be around people that are in the same space.
It really is. And it pushes you to come back to the next peer group meeting with a little bit, maybe better numbers, or a little, solve that problem you talked about the quarter prior. I think it's a motivating factor for us to go back and work on our businesses a little more.
It's definitely positive pressure. The accountability calls that I have with Cam and David out at Par 3 Landscape in Vegas they're great. I mean, just as that checkpoint of knowing, okay, for this hour, I need to have my stuff together and know what we want to talk about and what our challenges are. And I'll even kind of go back to the private equity side and looking at different companies. And even if you're not in the market or in a position to look at potentially selling your business or a part of your business to another group, whether it be strategic or financial partners, you should kind of always run your business like you are looking to do that. Okay. Because that's just going to force you to put that owner hat on versus the operator hat and say, am I doing the best thing for my business to increase value? And when I look at what companies that are going to really put a spotlight on it and go through a full quality of earnings report and really point out all the deficiencies in my financials and accounting practices and billing practices, and no, this isn't really kosher and stuff like that. If you run your business kind of that way, knowing that maybe in a year, everybody always thinks when you own a business, at some point in time, you want to sell it. I mean, if you hadn't thought that, you're fooling yourself as a business owner. If you know you're going to have to go through this, probe, of putting this big spotlight on your company, plan, keep them clean, run them well. Always assume that next month I'm going to have a audit come through and turn my company upside down. And if you run it consistently that way, you get in those good habits, then it's not a big deal. I mean, we're looking at a company right now where this is a hellacious process for them because they ran a good business, they generated good money, but they didn't really run the back office properly. They didn't have their books in order. They didn't have their documents organized. And now they're going through it and playing catch up. And it's a painful process. And as a potential buyer, I kind of look at that. Well, what else did you not really do right?
Yeah. Because you're getting the liability and risk that comes with buying a company.
Yeah. So nothing is off limits as far as, that you can't get past. But I think it's always better to act as if you're in the process of potentially selling your business, and you'll just run your business better that way. Like you said, every month you're looking at that bottom line number. That's important, not necessarily because, oh, well, this month I better have this much cash or I'm going to be in, a world of hurt next month. No, but that month is going to get looked at maybe by somebody else, a month from now, a year from now, 2 years from now. They're going to ask, why did this month go down so much when this month went up so much? And you're going to have to explain it. And you may have a great explanation, but if you can avoid all those kind of challenges, even better.
Yeah, I think it's knowing your numbers and knowing the correlation between your operating and sales team and how you handle the day-to-day, and then what the results are at the end of the month or the end of the quarter, and having a story to assign to the reasons why it went up or the reasons why it went down. That forces you to look at your business from an investment standpoint,
right?
Rather than just saying, oh, well, the market was tough that month or this or that. I mean, yeah, the market goes up and down, and COVID, we've had a lot of challenges and headwinds, but at the same time, there's a lot of companies, Stephen and I, we both know, who have actually done really well every year through COVID. So it's not just one size fits all in this. You've got to really look at things of, how is this impacting your business and what are you doing to counteract those headwinds?
Right. Exactly. Now you said it really well there, Justin.
So I do want to ask a quick question here before we wrap. For instance, and a lot of others I know, once you get to this 10 to 20 million in revenue, you start getting attention of a lot of these consolidation companies that are looking to partner, their platform companies looking to bring you into their umbrella.
Mhm.
And as someone who's deciding, maybe that finally having that aha moment that Sean had after the golf round in 2019, what's their first step? Should they respond to these email inquiries and say, yeah, let's meet? Should they find someone that can advise them? What would you say to someone who is looking to say, all right, I think I'm ready to start seriously looking at some deals? What would be your advice to them?
As far as, when's the right time, there are a number of factors. Definitely bigger companies, of course, are going to trade. And everybody kind of always back to, what do they trade at in terms of EBITDA? I mean, that's the question that if everybody could, get an answer that they trust and believe, from these consolidation firms or the generational equity type firms that are out there, what's my business worth? They want to know what that. Well, things are only worth what you can sell them for. I mean, that's the truth. And so what it's worth depends upon a lot of different factors. When you decide to take it to market has an equal number of factors, and who the prospective audience is of who you market it to. So you're not going to go to a big New York private equity firm if you're doing $300,000 a year in EBITDA. They're not going to give you any attention because they're looking to deploy larger amounts of capital. And it takes almost the same amount of time to do a small deal as it does to do a big deal in terms of due diligence work and audit. And so they're going to want to deploy that same money, more money across one deal. I think kind of a magic number to really look at when you need to hire some advisors, maybe looking at an actual investment bank, that million of EBITDA a year. I would say if you haven't done it before, definitely get some help. Going in full investment bankers and stuff like that. I mean, the downside is you got to pay them. They take a percentage of the deal. And all of these platform companies that are out there in the marketplace, I won't name names. We all know who they are. They would love for you not to have an investment banker or advisor in the mix. Okay. Not that their intentions are deceitful or anything like that, but they would kind of view it as easier and be able to pay a little bit less without that. Definitely, you get above, $2 million, $3 million a year in EBITDA, you'll want to look at doing a full auction process where you'll get investment bankers and they will develop a SIM and they will send it out, to hundreds of active investors that they're just waiting to get presented with deals, because you want to be that person that everybody wants to take to the dance. Because the more offers you get, the higher the price, and the prospective opportunities for good partnerships with good firms that are going to add value even after the close. So I'll say this, Crux with Superscapes, they were not the highest bidder. We did not go with the highest multiple of earnings, and we went with the firm that we thought was going to be the best to work with. And I think we struck gold, to the point where I didn't work with Crux before we closed the deal, and then developed such a good relationship working with them that now I'm on the buyer side. I was on the sell side before with Sean, and now I'm on the buyer side with Crux. And it's just been a great 3-4 year ride so far, and looking to continue with it. So, but those are kind of, I would say, some magic numbers of anything less than $1 million of EBITDA. You're looking at a very, very small subset of buyers. Those are going to be individual investors, somebody who maybe, what's the term? Just, you may know this. I've heard this before, where instead of being entrepreneurs, they're teaching in business school now just to go buy your small business instead of start your small business.
Yeah. We've had a few on the podcast.
Yeah. Those type of buyers will be in that million or less. Above $1 million, there's advisory services out there that will help take you to market. And there's a lot that are industry specific. The green industry has some that focus on that size. But then you get above, probably 2.5, 3. That's really where get a good banker involved and know kind of where their involvement and their lines of responsibility are going to start and stop.
Okay. Yeah.
You have to, as an owner, you have to continue to run your business, while you're going through this process. And this is a lengthy process. And so where I think Sean and I really worked well together, and I mean, he's my brother in life and in business too, he really just kind of let me run with it for that 4 to 6 months after we agreed to kind of work with Crux. And I was the point man on that deal. Had Sean tried to do that himself, it would have been tough. So don't underestimate the time involvement to go down that path of selling your business.
Yeah. And personalities too, right? Like I know Sean, you and Sean have different personalities, and certain CEOs who founded and grew the company, they have a different personality going to sit down with a banker or buyer, and things could get off track pretty quick, right?
Absolutely. Know where your strengths are. He built a great company from nothing to the level it was. Keep doing it. Keep growing it. That's the best thing you can do. And one of the best things about our partnership with Crux and Superscapes is that we, and myself as the operating partner now for Superscapes and the team at Crux, we take so much off their plate that they never have to mess with. I mean, Sean has not spoken to our banker probably in 3 years. I mean, he doesn't mess with that anymore. That's us. We handle that stuff. We deal with debt service. We deal with all of our reporting. We deal with now we have a controller as well who does the day in, day out bookkeeping. But as far as the finance side of owning a $50 million company, Sean got that taken completely off his plate. Go sell, go grow the business, go do what you're good at. That to me is a great quality in a prospective financial partner. Are they going to bring not just cash to buy you out or inject capital into the business that may be undercapitalized, but are they going to help you day in, day out, run the business with ideas, with expertise, with relationships, all those things you got to look at.
Well, it sounds like you definitely found a great firm, and so much so that you're now part of their team, which is pretty awesome.
Yeah, it's been great. It's been great.
To recap, if you're under $1 million, go join a peer group or hire a coach, get to $1 million is what I heard.
Yeah.
Because if it's not that hard to get to $1 million,
that's the easy. I mean, it's the hardest, probably I would say, to get to like 100,000. That's just a proof of concept that you can run a business. Yeah. You can go get just get the credit to go buy your first truck and all that kind of stuff. I mean, the very, very early on challenges of running a business, get to 100 million or 100,000 in earnings. Okay. From there to $1 million, it's just kind of repeat, do kind of the same thing. When you get above $1 million, then you're like, okay, man, I need to get some really smart people around me. I got some accounting challenges. I probably have some debt with the bank I got to mess with. I'm looking at bigger projects. I got to do proposals that I don't really know anything about, bonding stuff, immigration law, all that stuff. Okay, we see a lot of companies, and that's why in the landscape space, there's thousands of companies that the owner makes a great living. He's making his $300,000-$400,000 a year, taking his 3-4 weeks of nice vacations, driving a $150,000 truck, got his boat. I see that all the time. Okay.
Yep.
Congratulations to him. That's a great thing you have. But you want to get over that $1 million. Some of those guys they get out over their skis. It gets them out of their comfort zone. And so when you do that, you got to bring in some expertise. And so maybe that's time to bring in a partner. And a lot of those platform building companies, really ideally to get the maximum value of your business, you want to be that platform company.
Right.
If Justin, if X years from now you're looking to sell your business, you don't want to be absorbed by a platform. You want to be that platform, and then go do it again. And that's really where Superscapes did well. And we're trying to add on some smaller companies to the Superscapes kind of umbrella, because then you add a ton of value when you go talk about maybe retrading that entity.
Yeah, everyone talks about that initial platform company like Mariani and different, other, I'm not going to name all of them, but different ones that are being that starting point of the growing private equity space. So, well, with that, we always like to wrap up our episodes with our trade secret. So this is something we kind of coined as it's something you've learned working in the industry. You can't really find in a book. You didn't go read somewhere or learn in school. It's something that you've just learned through experience. And so, Stephen, what would you like to share for your trade secret for today?
I would say that just enjoy and truly like the people that you work with and partner with. We signed the deal with Crux and Wayne and Sean now are very, very close friends. You got to enjoy the people that you work with. I don't care if they give you a great offer. I don't care if they bring in a ton of expertise. You're going to be working with these people for a long time, a lot of hours. Just like them. Just know that you click, that you're similar mindsets. I hate working with people that I don't like, as a person individually. Either I don't like their business practices, their ethics, morality, whatever your deciding factor is. Just make sure you like them. Okay,
it's so important.
We met with some people that they flew in from, from out of the city. I mean, we were at a nice fancy dinner, and I'm looking over at Sean. I'm like, there's no way we're ever going to work with these people.
Yeah,
And just get out of those situations quick. Before we even saw numbers, they could have offered us double, and we said, nope, not interested. Just don't underestimate the value of liking the people that you work with.
That's such good advice. I learned a really important lesson early on in business from a mentor of mine, and they said, if you are wanting to go into business or do business with someone, always have them bring their partner or spouse with them. And you can really see someone's true colors, how they act when they have someone that close around them. Also, just how they interact with them. Do they bring them into the conversation? Do they kind of push them out? So that's always been something I've learned.
I think that's great advice. I've never done that, but boy, I may steal that, Maggie. That's
So, but it goes along with lines of exactly what you're saying. You can really see someone's true core values when they're in their comfort zone. So you want to work with those people that you feel comfortable with, both in and out of their comfort zone. So
yeah. And going back to our peer group stuff, I mean, Justin, I don't know, how your wife felt, but I mean, you took 10 or 11 business owners and their spouses to spend a week together in pretty close quarters. I mean, my wife was nervous about this trip.
Lilo was nervous, say the least. Yeah.
Yeah. And I mean, it just went, like, oh, they're all great people, but I had not met anybody else's spouses, in our meetings leading up to our trip to Italy. And it just went off great. Everybody got along, and it just re-solidified the value of that group of people that I want to continue working with for the long term, whether it be as part of the peer group or other ventures, or, I mean, you got to like the people you're working with,
Yeah. I mean, my husband had never met Justin, and last week they met for the first time on the golf course. So same kind of.
Yeah, I learned a bunch about Maggie. I didn't know.
Scary.
It was a good time though. And Stephen Wayne famously said when we were in Texas, he said it's easier to get out of a marriage than it is a business relationship.
No question. Yeah.
So pick your people wisely. That's a great share. Appreciate it.
Well, thank you so much, Stephen. We really appreciated your time today in the conversation. And we look forward to continuing the relationship and seeing what great things come from Superscapes.
Thank you, guys. Maggie, Justin, this has been great. Really enjoyed it.
Thanks, Stephen. Have a great day, man.
All right, guys.